The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos here in London. Dan Murphy's in Dubai and Ritika Gupta live from the G7 summit in France. These are your headlines.
First up today, US President Donald Trump has further extended a delay on strikes against Iran's energy facilities until April 6, at what he said was the request of Tehran's government. The president now saying talks are ongoing, later calling them productive.
They are begging to make a deal, not me. They're begging to make a deal. And anybody that saw what was happening over there would understand why they want to make a deal.
Oil prices ease and Asian stocks come well off session lows as investors digest Trump's deadline extension and Iran's move to allow some tankers through the strait. Futures here in Europe and on Wall Street pointing higher following Thursday's sell-off.
Waiting on Rubio, US Secretary of State gets set to join his G7 peers here in France for a second day of talks. Meanwhile, the EU's High Representative warns that the wars in the Middle East and Ukraine are becoming increasingly interlinked.
Russia is helping Iran with intelligence to target Americans, to kill Americans, and Russia is also supporting Iran now with the drones. So these wars are very much interlinked.
Anthropic reportedly eyes an IPO as soon as October as the AI player wins a preliminary injunction in its legal fight with the Department of Defense.
Fast-moving pieces for markets this week, and the latest US President Donald Trump has further extended a delay on strikes against Iran's energy facilities until April 6th, at what he said was the request of Tehran's government. The president said talks are ongoing, later calling them productive. In his first cabinet meeting since the war began, the president said he's not sure if Washington is willing to strike an agreement.
The Wall Street Journal's fake news and all these stories that get printed like, oh, I want to make a deal. They are begging to make a deal, not me. They're begging to make a deal. And anybody that saw what was happening over there would understand why they want to make a deal. But they say, oh, we're not talking to them. Anybody would know that. And only a total fool. And they're not fools. They're very smart, actually, in a certain way. And they're great negotiators. I say they're lousy fighters, but they're great negotiators. They are begging to work out a deal. I don't know if we'll be able to do that. I don't know if we're willing to do that. They should have done that 4 weeks ago. They should have done it 2 years ago.
However, the Wall Street Journal has reported mediators as saying Iran did not ask for a further pause on strikes and has yet to respond to Washington's 15-point plan, despite state media reporting the proposal was rejected. The outlet also reported the Pentagon's considering sending up to 10,000 further ground troops to the Middle East, bolstering the already large US presence in the region. Dan Murphy joins us now. Dan, it's so hard to get clarity on where things stand with these talks. What are you hearing there?
Ben, good morning to you. Well, of course, we are 4 weeks into this war, soon to be 5, and there's no resolution in sight. As you've been reporting, President Trump has extended his deadline for Iran to reach a deal for the second time. And in a social media post overnight, Trump said he is pausing this threat to strike Iranian energy sites for 10 more days, pushing the deadline out to April 6. He says these talks are ongoing, but as you say, the Wall Street Journal is reporting that mediators involved in the talks say Iran never actually requested that reprieve, and Tehran is ultimately still weighing whether to engage at all. Tehran also saying it's still waiting for a US response after rejecting that plan and also presenting its own conditions as well. They include war reparations, security guarantees, and of course control over the Strait of Hormuz. This extended deadline also buys the United States a little bit more time, and that's because the Wall Street Journal also reports today that an additional 10,000 troops are possibly on the way to the Middle East, essentially opening the door here for the president to pull another military lever if indeed these talks continue to go south. You heard there the president suggesting that it's not him who wants to make a deal, it is the Iranians. But exactly who on the Iranian side is representing that level of negotiation remains to be seen. We still don't know exactly who the United States is dealing with, and that lack of transparency is creating a fog of war scenario for markets. Overnight, we saw Wall Street pulling lower. Through the course of the Asia session, equities also drifting down. And at the same time as well, oil also incredibly volatile through the course of this week too, with prices drifting lower initially on the suggestion that we were going to see the president's extension, but of course still staying elevated as a result of the conflict which continues in the region, and of course the lack of clarity about exactly which direction this goes into next week and beyond. Guys?
Dan, thank you very much. Let's take a look at that market reaction yesterday. Our markets downbeat and the selling taking place right across the board. For the Nasdaq, that pullback of just over 2% contributing to selling already and taking the index into correction territory. And don't forget, some of the selling around the SAS Armageddon had already happened prior to the conflict in Iran. So layering on top of that, another 5.5% pulled off the index. Thanks to the war in the Middle East, this has impacted the fortunes of the Nasdaq, now down to the tune of 10.8% off its record high. The Dow not too far behind in terms of approaching correction territory, down to the tune of 9%. And actually the index that has lost the most out of those US boards, three major boards, since the conflict began, down just over 6%. In terms of the areas hard hit, it's communication services. And that's the area that you've seen very much pounded in recent trading patterns. It's down over the course of the week to the tune of effectively about 5% for the trading week, 3.5% of that coming through in yesterday's trade. So there's been a lot of action in recent sessions trading around the news flow. I want to take you to the Asian markets where we are seeing a little bit of a mixed pattern. Don't forget investors trying to respond to this fresh deadline, wondering what it means in terms of risk assets, whether there's going to be anything that happens in the meantime militarily, or whether this is now effectively a pause for markets to take a breather. And what you're seeing across in the Japanese market, we are down 0.4%, so still in the red, similar size declines on the Kospi. And again, these are two markets across the region where we look for some of that risk appetite. Two markets very much at the forefront of that tech trade that has been beaten up, but also exposed again to that energy story. The Hong Kong and Chinese markets both putting on some faint green for the Friday trade. To the European futures on the back of that selling that we also witnessed here yesterday, we're down 1.1% on the Stoxx 600, the European benchmark. For the trading week, we are still up, so we're still attached to some of the green here in Europe, but slightly more resilient than that US picture. But that said, over the course of the trading month, we're down about 8+% on the benchmark. This morning, as we trade around the headlines again, we're seeking modestly firmer territory. Now, US futures, the early suggestion is that we will also trek firmer into the green, and it does suggest that markets are a little bit more cautious, but to the upside at this stage, Ben.
France's foreign minister says discussions are underway over a draft UN Security Council resolution to reopen the Strait of Hormuz. According to the proposal obtained by the Associated Press on Tuesday, the resolution calls on Iran to immediately cease all attacks against merchant and commercial vessels and would authorize countries to use military action to secure passage through the strait. Speaking at the end of the first day of the G7 foreign ministers meeting in France, the host country's foreign minister, Jean-Noël Barrot, called the mission strictly defensive.
Le président de la République a
The President of the Republic has proposed an international mission involving countries willing and capable of contributing. So once calm has returned, traffic flow can resume as quickly as possible. The purpose of this mission is strictly defensive, by escorting ships which can contribute to lowering energy prices.
The US Secretary of State Marco Rubio making a late arrival, landing in France this morning to join the second day of what are undeniably high-stakes talks at the G7. Ritika Gupta is there for us and joins us with more now. Ritika, just give us a look ahead to what we can expect today.
Well, it's day 2 of the G7 foreign ministers meeting here in Rambouillet, just an hour outside of Paris. The allies will be awaiting the arrival of US Secretary of State Marco Rubio to gain more clarity on the war in the Middle East, because there have been so many conflicting reports. The US has said that Tehran is begging for a deal. Tehran has said that they rejected the US deal and putting forward their own terms. Then the US say that they are negotiating with Iran, but then at the same time sending tens of thousands of airborne troops to the region. So they want more clarity on that. The other topic of discussion will be the Strait of Hormuz, which is effectively shut, choking off about a fifth of the world's supply of oil. The G7 is going to continue to push for a de-escalation and diplomacy over using military intervention. Then the other issue is, of course, Ukraine, with the Middle East war overshadowing the events in Ukraine, and the negotiations, the US-led negotiations to end the war, have all but stalled. So they will discuss how to get Ukraine back on the agenda at a time when there are concerns that the US is diverting both its attention and resources away from Ukraine and onto the Middle East, even with reports from that the Pentagon is weighing diverting weapons that were specifically for Ukraine over to that conflict in Iran. What is becoming increasingly apparent, though, is just how interlinked these wars between in the Middle East and Ukraine are becoming. This is something that the EU's High Representative Kaja Kallas weighed in on at the G7.
We are raising this issue that we see that Russia is helping Iran with intelligence to target Americans, to kill Americans, and Russia is also supporting Iran now with the drones so that they can attack neighboring countries and also US military bases. So these wars are very much interlinked.
And it's not just on the military front, it's also those rising oil prices as a result of the Middle East war. Those are giving Russia a boost, but also pressuring Ukraine and its allies in Europe.
Rivka, thank you very much indeed. We'll join you again a little later in the show. In the meantime, the OECD has warned that prolonged disruption to shipments through the Strait of Hormuz could lead to a significantly worse spike in inflation. In its latest interim report, the group forecasts headline inflation across the G20 to reach 4% this year in 2026, 1.2 percentage points higher than previously forecast, before easing to 2.7% next year as energy pressures fade. The UK economy is set to face the biggest hit to growth from the war among its G20 peers, with the OECD downgrading its 2026 growth forecast by 50 basis points to 0.7%. Meanwhile, inflation is set to surge to the second highest rate in the G7, up to 4%. Aaron Kapitin is Global Head of Economic and Strategy Research at UBS and joins us now. Aaron, good to have you with us. These upgraded forecasts from the OECD, they differ from the UK's own Office for Budgetary Responsibility forecasts. They are more pessimistic, although the OBR's forecasts were prior to the Iran war. Are those forecasts in line with what you're sort of expecting, anticipating? How do you see them?
So it's difficult to compare these forecasts because they're changing by the day, and everyone will have a completely different baseline of what they think the landing zone is for energy, right? And so the forecasts are super sensitive to that. We put out sort of a range of scenarios a couple of days ago or yesterday where we sort of look at that. So for us, if you're looking at this going on another month or so, globally, I think you're looking at probably something like 30 basis points lower growth and 90 basis points more inflation. If it goes on beyond that, you're looking at much bigger numbers than a couple hundred basis points inflation, maybe a percentage point or so of global growth. So it just depends on where you think this conflict is going.
In which case, based on the different scenarios you have modelled, short of ending the conflict, is there anything that policymakers can do, whether that's in terms of monetary policy or fiscal policy, to try and lessen the negative impact of what we're seeing?
Well, so the policymakers on the monetary side are going to make it worse, right? So in the sense of they're going to lean against the inflation. So I think that, and the market is sort of pricing that quite indiscriminately, right? So I think what people are sort of doing is assuming this is the 2022 playbook. So inflation goes up, the central banks do not want to be behind the curve again. They will basically, if you were expected to cut, you don't cut. If you were expected to do nothing, you hike. I think in first instance that is what they will actually do, right? So as you go through these oil price progressions, the fiscal policymakers are already, I think, acting, right? So you've seen it in Spain and Italy, so you're going to see, I mean, we have a table showing this for the whole world. We're seeing the same thing as in 22. So price caps on fuel, subsidies, VAT cuts, you name it. But those numbers are still pretty small, right? I think that even on the fiscal side, everyone wants to see sort of how bad this is going to get. But there will be a point for the central banks in particular where for some central banks that will flip, right? So if this gets bad enough and oil prices go high enough and gas prices go high enough, then at some stage the growth concern is going to start to outweigh the inflation concern. And that's then when for some central banks the policy reaction flips. Not for all of them, right? So that's what's going to be interesting. So we think for the Fed, for instance, we think that will flip. But for the ECB, it's not so clear.
So it could be a situation of hiking into a recession potentially if we end up with the extended conflict. To the point about bond markets and what they do, because they're pricing the scenario of inflation coming into the mix. And if you look at the bond yields, even the longer term bond yields, Germany's 10-year bond yield has now hit its highest level since 2011. We know stateside we've marched up, about 40 plus basis points on the 10 years since the conflict began. How are you thinking about that bumpy ride for the bond markets depending on a short conflict versus an extended conflict?
Yeah, so in first instance, it's basically bear flattening, so we're the front end's going up. Then the question is whether or not, and it is very binary, so if you go into a recession, then we're going to see massive bull steepening again. So then basically these front ends come back down. But it really hinges on that, right? So you could get, things would definitely get worse, right? If you go to say, $130 oil and your landing zone is at, let's say 100, then I really think these, in level terms, I think 10-year yields are going to get stuck at in the US about 450, and in Europe they'll be 3 or a bit above 3. But in a scenario where potentially the Fed starts cutting, then these bond yields could come all the way back down, right? So for the Fed, we have them coming down to something like 250, but this sort of requires like a recession and a zero lower bound type of scenario. I think more important actually than the bond market from my perspective now is the equity market, right? So if you're thinking about the dynamics of these feedback loops where the financial conditions tightening could actually contribute to a recession, then I think particularly for the US, the equity market is now much more important, right? So if you have think about it this way, so you've got equity wealth is about 232% of GDP. Right, so if the S&P goes from 6,500 to 5,500, that alone will take a full percentage point off of GDP growth. And if you think about the composition of what's been happening in the US, it's basically just been AI capex and wealth effects. And so if you start to remove and wealth effects about the majority of consumption about half of the growth. So if you remove that, then suddenly I think the threshold price at which the economy responds to oil comes way down, right? And so then I think it gets quite hairy. And so at this stage, it's difficult for us as forecasters because it's become endogenous to how the equity market is going to behave. And when we sort of see the overnight price action, we get nervous because basically the equity market has de-risked but not actually in any way capitulated and is not pricing, I think, these type of scenarios yet.
We keep talking about the retail investor in such a positive fashion about how well they've done, how they've second-guessed what hedge funds have done and they've performed. They've been on meme stocks and everything else that's gone up, Nvidia, for instance. And you're saying this could be the opposite story where they've got the market wrong, and if it goes down, it destroys the wealth story. To the point around the extended downturn or an extended disruption, the downside risk here, you've got a number 5,350 could be the downside on the S&P 500. That's the worst case scenario?
That's the worst case scenario. I could come up with even worse case scenario. But so that is the scenario in which, so the way we think about it is if oil goes to 150 and gets stuck there, and that really requires disruption beyond the end of April, then and then the equity market corrects as well, because these two things are going to be linked, then you will have a recession and you'll have 3 quarters of negative growth. And in that scenario, you run a traditional recessionary playbook, which is that the trough will be 53.50, and then by the end of the year, you're back up to maybe 57.50 or something like that. But that's really just if you get to those type of extreme scenarios.
Okay, Arend, we're out of time. There was a really interesting point in your note about intensity of oil intensity and the consumption, how relative to previous 1970s levels, it's actually making up a smaller share of GDP, which is why we've perhaps seen a muted impact. We will touch on that next time you're with us, I promise. A really interesting point. Arend Kaptein, Global Head of Economic and Strategy Research at UBS. Thanks for joining us. And thank you for joining us. Don't go away, certainly not, because we've got plenty coming up, including this. Anthropic reportedly eyes an IPO as soon as October, which could raise more than $60 billion. Plus, how's this for a company cocktail? Pernod Ricard and Jack Daniels, a measure of each, maker Brown-Forman say they're in talks to merge in a move that sends shares surging. And we'll bring you Carolyn's conversation with the former German finance minister Jörg Kukies next.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Hello, welcome back. The European Parliament has given unconditional approval to the EU-US trade deal following months of delays. The vote included a number of additional safeguards to ensure that the US complies with the deal it agreed last July. The pact would set the tariff on most EU goods exported to the US at 15% in exchange for European investment in the US and the removal of tariffs on US industrial goods imported into the EU. The deal will need to be approved by the bloc's 27 member states before being implemented, with a concluding vote in the European Parliament expected in April or May. The US mission to the European Union welcomed the vote to implement the trade deal, saying it delivered stability and predictability. They called the need to rebalance the economic relationship between the US and the EU one of President Trump's highest priorities. Speaking to CNBC, Washington's ambassador to the EU, Andrew Puzder, highlighted how the delay in passing the deal has caused frustration and his thoughts on the risk of it being suspended.
Well, it was frustrating. The United States has really been in compliance since the framework agreement on trade was released back in August of last year, and we've been waiting for the EU to go through its procedure. We understood they had to go through a procedure. We just didn't think it would take 6.5, 7 months. So we're anxious to see it done, and this was a big step, and I don't want to underplay it. This was a big move in our transatlantic relationship.
Obviously, as we've been reporting, there are safeguards built into this from the EU's perspective, one of which is that the deal can be suspended if America threatens the territorial sovereignty of any EU territories, for example, Greenland. You're quite relaxed about that?
At the moment, I don't want to prejudge any of these amendments. They added 5 amendments. None of those amendments were in what the Council originally approved. So now it goes back, I said, to this negotiation, and I don't want to influence those negotiations on any of these particular amendments, but none of them were in the original deal. So we'll see what the Council says when it's faced with the amendments that Parliament added as part of its approval process.
The Middle East crisis and the wider energy shock has prompted countries around the world to move to secure their energy supply. Carolyn spoke to Kaja Kallas, the chair of the Institute of Geoeconomics at the Hong Kong University of Science and Technology, and asked her about the impact of the war in Iran on China's energy policies.
When it comes to China, it's about preparation for the long term. And China has been preparing for greater shocks, for U.S. truculence, long before it actually got realized. So there's a long-term 10-year, 15-year plan of strategic self-sufficiency in technology, but now in energy as well, diversification. But it's kind of staying autonomous, but still staying connected and opening up to markets where it should be. And in terms of the energy crisis, it's very clear that autonomy is ever more important.
Carolyn joins us now live from the shores of Lake Como. Carolyn, there's a lot of soul searching about the energy security crisis that Europe finds itself back in, the security implications of the Iran conflict. Just walk us through some of the conversations you're having there at Ambrosetti.
Just on that final interview, Karen, that was a fascinating one because we also talked about how the conflict in Iran is secretly strengthening China's hands going into the crucial meeting between President Xi and President Trump, which of course will now happen in the month of May. And it's been pretty interesting that President Xi has not said anything since the start of the war. He's just been watching it, of course, being worried on the sidelines, but the absence of any commentary has been absolutely noteworthy. For the full interview, do go on CNBC.com. And of course, this energy price shock is reverberating across here, the pretty peaceful shores of Lake Como as well. But as far as the discussions here are concerned, that's what everyone is talking about, of course. This morning, I managed to catch up with Jo Koukis, the former finance minister of Germany. And of course, for Germany, it is a deja vu. Going back to 2022, I asked him whether Germany now, a couple of years later, was in a better position.
Well, I think Germany, of course, suffers disproportionately because we do still have a fairly high fraction of industrial production in our country, even though it suffered from Corona and the energy price spike after the Russian war of aggression against Ukraine. So in that sense, yes, our forecasts are being taken down more than others. However, we do have the fiscal expansion and the expectation of economic reforms that's priced into some forecasts that balances it a little bit.
Are there measures, and of course the federal government in Germany has already taken some measures to offset the pain from higher oil prices and gas prices. Should there be bigger measures? Are you a friend of state-led intervention when it comes to these external shocks?
Well, I mean, on commodities that are so fungible, such as oil and gas, it's always hard because it's a global market. And if you set price caps, for example, as the European Union has often discussed, then the ships just sail around Europe and go somewhere else, right? So in that sense, yes, it's good to think about, especially what the German government has been doing is to make sure that there's no cartels, to make sure that there is true price competition for the end consumer market. That I think is very good and necessary in a market economy. But artificial things like price caps usually backfire because they just reduce supply.
That was Jo Koukis, the former finance minister of Germany, and he pointed to one very important debate happening in German parliament today. That is the debate on the pension reform. Could be hugely influential for the German economy going forward, given that it will be tied to the capital market, something that he says is currently underappreciated by the market. So that's happening today. On a programming note, we will be speaking to Nouriel Roubini later on today. Of course, the so-called Mr. Gloom. He now calls himself Mr. Boom. And of course, we'll also be talking to Philip Hildebrand from BlackRock later on. Catch that on CNBC.com later on.
OK, Karen, we must get a graphic made up for Mr. Gloom and Mr. Boom at some point. But thank you very much. We look forward to that. And thank you for your reporting there as well. Do stay with us. We are looking ahead to the trading session in Europe after a day in which all the main benchmarks ended lower on Thursday. A stronger open being called across Europe this morning. Stay with us.